With another bearish close under the books, we officially have 7 consecutive bearish weeks inside of the major index markets. This includes the SPY, the Dow, and the Nasdaq, and the Russell is at 5 consecutive bearish weeks. So the question I'm looking to answer in today's video is, when has that happened before in history? And we'll go all the way back to 1999. So I'm looking for places in which we've had 7 consecutive weeks where our closing price has been less than the open, we have red candles, and we've had that 7 times in a row. Now the twist here is, instead of going back and manually trying to find where we have these 7 red candles, we'll use thinkScript instead to try and make the process a little bit faster, more efficient, and scalable. We'd like to repeat this on the other index markets as well. Now, before we move into writing the code for this, let me first show you the results because I find them to be a bit more interesting, and that I think will be worthwhile to decide if you even care about this. For the S&P 500, we have 7 consecutive bearish weeks, and that's happened 1 time going back to 1999. So we don't have that many data points that we can refer back to, but we will take a look at that 1 time to try and see what happened in the weeks after we had 7 consecutive bearish weeks. Did we continue to see more bearish activity, or did we see some sort of a rebound? Now, the next market, the Dow Jones, 7 consecutive bearish weeks, true today, but that has never been true before, going back to 1999. So that's an interesting data point where this is happening for the first time. Now, if we switch gears and go to the Nasdaq, same 7 consecutive bearish weeks, but there we have 4 data points. It's happened 4 different times going back to 1999. So we can go back and study those to see, does this period again tend to last, or do we have a short bounce for, say, a few weeks before either continuing a bearish market or continuing a bullish market, whatever it is. And then finally, the Russell, a little bit different. 5 consecutive bearish weeks instead of the 7 inside of the index markets, and that's happened 9 times going back to 1999. So a lot more occurrences here that we can go back and refer in terms of trying to see what tends to happen afterward. All right, let's now move into writing the code. It's very simple. It's just 2 lines, and once we do that, we can start focusing in on the S&P, the Nasdaq, and the Russell, where we actually have some historical data points. Now, inside of thinkorswim, I'm first on a weekly time frame chart here, and I'm going back to the max available data that we have available to us. So that's my time frame settings. Once you have that, click the studies icon and then click create here, and we can start writing some code. Now again, this is very simple. We first need to define what a red candle is in code form, and for us, so if we say bearish candle, that's just close is less than open. So if we have our closing price less than our opening price, that gives us a red candle, and we're looking for 7 consecutive occurrences of that. So to define that, we can say plot signal, and here we're going to say is the sum of bearish candle over the past 7 bars greater than or equal to the number 7. So to break this down just a little bit further here, this first variable, bearish candle, is simply looking if we have a red candle. If we do have a red candle, and this is on that weekly time frame chart, then it will return the value 1. If it doesn't have a red candle, it will return the value 0. Now in the next line, we're taking those 1s and 0s, and we're taking the sum of the past 7 candles. So if we've had 1 7 times, then that sum should be 7, and that's how we get to 7 consecutive candles. Now if I click OK here, let me move this down to the lower panel. We click apply. What we can see is a line that for the most part stays right down here at 0, and whenever this condition is true, meaning we have 7 weeks, that line shoots up to the value 1. Now this is the S&P, and if I scroll back, this is our 1 occurrence which happened in 2001, that bear market. So if I scroll in here a little bit further, this was the 7th week when we see that first dart, and this went all the way down to an 8th week. The 8th week was sort of the bottom, if you will, for that first temporary leg, before we saw a bit of a recovery inside of the S&P. So that's an interesting data point. This right here was the 7th candle. If we count that, 1, 2, 3, 4, 5, 6, and 7. And then after that, we had one final candle, which had a greater wick, leg up higher for 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks, before we then continued resuming this bearish trend and made a lower low. So that's the S&P data point, the one time it's occurred, which was in 2001, another bear market. So I think that lends somewhat of an interesting data point here. We're getting close to that 1272. If we do expect an 8th week next week, 371.94 is where I'm looking to buy this dip here, looking to try and play that overall pattern that, hey, we're now getting extended, at least in this bearish market, looking for some sort of a temporary relief rally, if you will. Now we move on next to the Dow. If I zoom out, you can see the Dow, 0 occurrences going back that same time period. Move on next to the NASDAQ. The NASDAQ, 1, 2, 3, and 4. So let's zoom into each one of these and study what happened a little bit better. So inside of the NASDAQ, the first one also 2001, March 2001. 1 week, 2 weeks, 3 weeks, 4 weeks, 5 weeks, 6 weeks, 7 weeks. This is where it starts. Inside of the NASDAQ, we go 8, 9, 10, 11 weeks before we really start to have that temporary relief. And that temporary relief rally is not as dramatic as something like, say, the S&P as we just saw. This is much smaller in terms of that leg up higher before the NASDAQ continues rolling over. So inside of the NASDAQ, we see that we don't really tend to bottom out around that 8th week, but we continue falling a little bit more. At least that's what happened in 2001. Of course, the .com bear market, which would make sense. Now we come forward here, 2002, another time where that happened. We're 7 weeks after that, we had 1, 2 weeks of bounce, another bear flag, if you will, before continuing that bearish trend, breaking our previous low and making a lower low in terms of this trend. So that was the second occurrence inside of 2002. Keep moving forward here. Our next occurrence is 2004. 2004, once we hit the 7th week, again, we continue having an 8th week, a 9th week, and really a 10th week, even though that closes green, before we then have a slight bounce up higher. So the NASDAQ, so far, we're seeing 7 weeks. It tends to start to exhaust, but it does go a little bit further than 7 weeks as well. It's not as respective of that 7-week idea as, say, something like the S&P. And then finally, 2008, where 7 weeks takes us to this candle right here. And after that candle, we had 1, 2, 3, 4 weeks of a slight relief rally before, again, continuing that same downward trend. So across the board here, we're seeing that trend continues. It's just a question of when does that relief rally really come in. Now, we've so far covered the S&P, the Dow, and the NASDAQ. The last market we have left is the Russell, where we have 1, 2, 3, 4, and 5 bearish weeks. So inside of our code here, I can change this to now, instead of going back 7 weeks, we can look 5 weeks. Click OK. And here we have, again, a lot more data points. So going back to 2000, 5 weeks, 1, 2, 3, 4, 5. So inside of that first data point here, this is 2000, we see the Russell. While we do hit that 5-week period, we chop around, we have a temporary relief rally before, again, continuing that same drop down. 5 weeks one more time in 2001. This is same March 2001. It bounces along with the other index markets. A nice bounce similar to the S&P as well. Keep coming forward here. Our next data point is 2002. And in 2002, once we hit that 5 weeks, we can see that that continues to stay prolonged for quite some time. So 2002, 5 weeks didn't really stop anything there inside the small caps. In October of 2002, slightly different story there, where we do have a relief bounce. And then zooming out, our next data point, March 2005. Again, once we hit that 5 weeks, we continue resuming, but this, I think, was a slightly different context, where 2005 was not in the middle of something like, say, a bear market, like that 2000 and 2001 data point that we had earlier. Now, coming in to our final few data points, 2008, 1 right here, where again, 5 weeks, we bounce. Another time, 5 weeks, we continue going down a little bit further before having that leg up higher. So what we're starting to see, at least to sum this up, another data point there, but I think we have the overall idea, which is inside of these major markets, once we start to see some sort of exhaustion period, we're looking for a temporary relief rally, but in the context of a bear market, that bear market eventually continues down lower, and we're looking for that flag or trend line, any way to try and play that retracement move up higher to break, and then continue playing down lower to break previous lows. So I think that's the trend following strategy, then it also gives you, at least in the case of the SPY, a reason why you might be looking at 371.94 as a potential area where you may see at least somewhat of a pause and somewhat of a small bounce there, confirmed with some previous data points that you might find useful. Alright, I hope you found this video to be useful in terms of gathering research for the weekend. Maybe you can twist this for any other individual stocks, ETFs, other markets, whatever it is, to try and at least dive a little bit deeper into whatever research you may be trying to perform. Take care, everyone. Good luck. I hope you enjoy your weekend, and we'll see you in the next update.